you're probably not thinking about gold right now. Most people aren't. But while retail investors chase AI stocks and crypto hype, billionaires like Ray Dalio, Stanley Druckenmiller, and central banks themselves are quietly hoarding gold at a scale we haven't seen since the 1970s. And here's the crazy part. It's not about tradition or nostalgia. It's about protection against what's coming. At the end of this video, you'll understand exactly why the smartest money on earth is turning to gold, and how you can protect and grow your wealth by doing the same, even if you're just getting started. So let's talk about what they know that you don't. Gold is not just a shiny metal, it's a signal. A signal that confidence in the global financial system is weakening. In 2022 and 2023, central banks bought over 2,000 metric tons of gold, breaking a 55-year record. Countries like China, Turkey, and India aren't just diversifying their reserves. They're preparing for a world where the US dollar might no longer be king. And it's not just governments. In his Bridgewater fund, Ray Dalio, a legendary hedge fund manager, has consistently allocated a portion of his portfolio to gold, calling it a storehold of wealth. He doesn't do this because it looks good in a vault. He does it because in times of high debt, political instability, and rising inflation, gold has historically protected purchasing power when everything else failed. Just look at the 1970s. When inflation hit double digits and markets were volatile, gold went from $35 an ounce to over $800. That's a 2,000% return in less than a decade. Now think about today. Global debt is at an all-time high. Inflation, though cooling in some regions, is still well above targets. And geopolitical tensions, Russia-Ukraine, China-Taiwan, Middle East conflicts, are turning the world into a pressure cooker. When the system feels fragile, gold becomes the fallback. Not because it pays dividends, not because it compounds, but because it doesn't rely on anyone's promise to pay. It's money that has no counterparty risk. And billionaires know this. They know that fiat currencies backed by governments that print money at will are vulnerable. They've seen what happens when trust erodes. 2008, 2020, 2023 regional banking crisis. And gold, it quietly survived every one of them. But here's where it gets really interesting. While the media distracts us with stock tickers and crypto crashes, gold is being weaponized by nations trying to reshape global power. China has been accumulating gold reserves every month since late 2022. Not for jewelry, not for diversification, but to reduce dependence on the US dollar. Because when you trade oil, food, or weapons in dollars, you're vulnerable to US sanctions. And the BRICS nations, Brazil, Russia, India, China, South Africa, are actively working to build an alternative financial system where gold plays a critical role as a trust anchor. In fact, Russia, after being hit with sanctions in 2022, began settling some international trades in gold and Chinese yuan, bypassing SWIFT and avoiding the dollar completely. This shift is subtle but seismic. Because if the world's major economies start using gold-backed systems or reduce their dollar reserves in favor of gold, the demand and price of gold will explode. And investors who position themselves early will benefit the most. Take a look at what's happening on the corporate side. In 2023, Berkshire Hathaway shocked the investing world when it took a $564 million stake in Barrick Gold, one of the largest gold mining companies. Warren Buffett has long criticized gold as a non-productive asset. So why the sudden change? Because even the most disciplined value investors understand that in times of uncertainty, capital preservation comes first. And gold, unlike fiat or stocks, doesn't depend on earnings reports, politics, or interest rate policy. Now imagine you're building your portfolio. Maybe you're diversified across stocks, some bonds, maybe even a bit of real estate. But ask yourself, what happens if inflation spikes again? What happens if there's a currency crisis? What if the next geopolitical flashpoint shuts down global trade? Gold doesn't need a perfect scenario to rise. It just needs fear and a loss of faith. And the signs are already here. When regional banks collapsed in the US in early 2023, gold spiked above $2,000 an ounce, despite high interest rates. That shouldn't have happened, yet it did, because investors were seeking a safe harbor. You don't wait for the fire to start to buy insurance. Billionaires aren't buying gold because they're scared. They're buying because they're prepared. And if you wait until headlines scream currency crisis or hyperinflation, it'll be too late. The price will have already moved. So how do you actually invest in gold? You don't need a vault in Switzerland or stacks of bullion bars under your bed. There are smarter, more accessible ways today, even for small investors. The first is physical gold. Coins like American Eagles or Canadian Maple Leafs are globally recognized, easy to store, and retain value regardless of currency volatility. They're ideal for long-term holders who want complete control of their wealth. Then there's gold ETFs like GLD or IAU, which track the price of gold and can be traded like a stock. These are perfect if you want exposure without worrying about storage or insurance. However, remember, you're buying paper gold, not the metal itself. If you're looking for leverage, gold mining stocks might offer higher upside. Companies like Newmont, Barrick Gold, or even junior miners can outperform physical gold in bull markets. But they also carry more risk. You're not just betting on gold, you're betting on management, operations, and geopolitical stability where they operate. Another option, digital gold. Platforms like Vaulted, OneGold, or even blockchain-backed services allow you to buy fractional ownership of real gold stored in professional vaults. It's instant, secure, and gives you the benefit of owning allocated gold without physical logistics. But strategy matters. Most billionaires aren't going all in on gold, they're hedging. Think of it as the insurance part of your portfolio, something you hope never to need, but you're glad it's there when everything else falls apart. A typical hedge might be 5% to 10% of your portfolio in gold or gold-related assets, enough to protect but not enough to drag down returns in booming markets. Because gold isn't about getting rich overnight. It's about not going broke when the system fails. Dalio put it best, if you don't own gold, you know neither history nor economics. And history is repeating itself, just with different players. So whether you're managing $500 or $5 million, the question is the same. What are you doing to protect your wealth when the next shock hits? Because billionaires have already answered it with gold. Now it's your turn.